Hey, Mike here. I got to talk with you right now about the stock market because I've been looking over things and see some important developments that you need to be aware of. I'm calling this presentation the Summer Stock Market Honey Trap because it's going to be full of stock market surprises for all. And you might be wondering, well, who's going to be trapping who? Is the bear going to sneak up on the individual investor and eat him? Or is the individual investor coming back to trap the bear with a nice market rally? Well, to answer these questions, first of all, let's look back at the basics of market analysis. I break up the stock market into 4 phases. Stage 1, basing phase that acts as a prelude to a new bull market, a stage 2 bull market, a stage 3 topping market, and a stage 4 bear market. And you can quickly recognize what kind of phase you're in by what a market average is doing in regards to its long-term 150 and 200-day moving averages. In bull markets, those averages act as support and they trend up. Well, you can see that here's the S&P 500. We're now in a 5-year bull market in which, yes, these moving averages have acted as support since 2009. Before that, we had a bull market from 2003 to 2007, which lasted for 4 years. Now, all bull markets eventually come to an end in a matter of time. So because we're in a 5-year bull market, that makes each week, each month that goes by more risky than the last one because it brings us closer to the end point. Nothing lasts forever, just as no bear market lasts forever too. So we've got to be aware of that and realize that there's a risk that we're actually in a stage 3 topping market, which acts as a prelude to a bear market. I think that's what we're actually in. During a topping phase, several things tend to happen. One of them is that people get wildly bullish on the market. There's a saying that bull markets thrive on skepticism. They climb a wall of worry. Once that wall of worry is totally climbed and everyone is on top of it, you're in a situation which almost everyone is now very excited and very bullish on the stock market, and almost nobody thinks the bull market will end. I think that's where we are. One of the things, though, that happens is that market participation narrows. Fewer stocks and fewer sectors continue to go up in the final phase of a market, and that actually becomes more and more and more narrow. It's fewer and fewer stocks going up. And as I'll demonstrate, that's exactly what is going on. Market volatility also tends to shrink in a stage 3 top, and markets tend to fool people by breaking out and then going nowhere over and over again with false breakouts. What happens is this causes traders to churn their money over due to weak trends. Well, I think that's something we've been seeing. However, I also think a rally is about to come. But let's talk about the troubles in the market. Investors Intelligence Survey, which surveys investment writers and advisors, the number of bulls in that survey reached over 60% in January. Well, the last time it got to level it got to in January was right before the 1987 stock market crash. That tells you how rarely that the survey reached that point. It was a total insanity. Now, it dipped in February and in March. But now we're back over 55%. Another thing that's troubling is the level of margin debt held by individual investors and institutions reached a manic level at the beginning of this year. It's still at a manic level. And frightening margin debt levels can lead to giant corrections and new bear markets. You can see what happened in the last two times preceded horrible bear markets. And a long-term worry, something that we should be concerned about, is that from a fundamental basis, U.S. stocks as a whole are overvalued. The cyclically adjusted PE for the S&P 500 is over 25. Well, yes, it got to 45 in 1999 and 2000. It got high also in 2007. But historically speaking, it's at the levels seen in the late 60s and 70s. It's the important thing is it's not cheap. It doesn't really, if you're a fundamental investor looking at trying to buy stocks at cheap valuations, as a whole, you have a very difficult time doing that in the U.S. stock market, and the U.S. stock market is overvalued. Historical studies show that markets at this valuation tend to provide poor returns over the next 5 and 10 years. Another worry in the market is that the so-called momentum monsters that were big performers in 2013 and the beginning of this year, they died out in March and topped out and had very violent corrections across the board. The biotech stocks got smashed. Internet stocks got smashed. Stocks that were attracting the popular imagination of the individual investor caused pain in March, in April. Stocks like Yelp is one example, stocks like Facebook. Now, you may not own these stocks yourself, so you may not have suffered from their violent correction that occurred the past couple months, but they're important stocks nonetheless. And I want to tell you why they're really important for people. Even though not very many people actually own Facebook or participated in the rallies and the Yelps, the 3D printing stocks and these things, they're very important nonetheless, because what they did was, by their very existence and the big gains they generated, they provided proof to the individual investor and the mass man that there are big gains happening in the U.S. stock market. The fact that Facebook went up a lot showed the individual investor that there are hot stocks out there and hot trades that are possible to make. They provided them with inspiration, and that inspiration is continuing. That's the ultimate reason why Facebook's important. It provides the belief that Jim Cramer or people that are leaders of the bull market can feed people hot stock picks, and people want picks right now. I can tell you, because just the other week I went to Las Vegas Money Show, and I walked around and I talked to people about the stock market. I wanted to see, were people excited about the market? What were their attitudes about investing right now? And I got to tell you, the people that attended this show were very hungry for stock picks and ideas. That's why they were there. And I talked to, let's say, 20 people. One person was skeptical, and the other 19 were very hungry for picks. People were walking around, picking up literature for picks, picking up, they're just hungry for ideas. And they didn't care about valuations, or they weren't skeptical. They didn't care that the market went up for 5 years. The very fact that the market went up for 5 years is what brought them to the money show. The very fact that, yes, they didn't own Facebook, but the very fact that Facebook had gone up and was a hot stock at one time meant to them that maybe they can get another one like it. The truth is, the masses are back in love with the market, and they now love their leaders again. They believe in Janet Yellen. They believe that she will keep the market going up for them. And they think Ben Bernanke did that too over the past couple years, and they have confidence now in their abilities to continue doing that. All that said, though, there are cracks in the market that you must know about. Remember, I told you, in mature bull markets, as they reach an endpoint, participation starts to fade from the market. Fewer stocks go up. 38% of the S&P 500 components this weekend are in the red year to date. 14 out of 30 of the Dow stocks are in the red this year. Now, I use TC2000 software to analyze the stock market. It breaks the stock market up into 239 sectors. 106 out of 239 of these sectors are in the red right now, year to date. Ultimate implications of this: we are late in the bull market. We are most likely in a stage 3 topping phase that will act as a prelude to a new bear market at some point. Topping phases like this can last weeks, they can last months, they can even last a year. I'm telling you these things not to tell you to get out of stocks right now. On the contrary, as you'll see in a moment, I actually think a rally is coming. But you've got to be aware of this and understand the big picture of what's happening, because these people do not understand this. They're just chasing the market and they don't know what they're doing, and you've got to understand what's going on, okay? People are going to ignore the big trend of the market and just focus on what the S&P 500, what the Dow is doing. The reason they do that is what I call the 12-month rule. Basically, what happens to the mass investor is that they just see what a market has done in the previous 12 months and expect that to happen forever. Therefore, they're extremely bullish on the market right now, and if the market rallies and goes up again, they're going to get sucked in and want to buy and want to be a part of it and ignore any potential risk. And in fact, they'll end up buying at some point into what will prove to be an ultimate top, or at the minimum, a risky and giant correction that will suck and trap people down. That's the trap of the summer that's coming. Up days will suck more and more people in until one day it comes to an end. The truth is, the brutal truth, is that money managers cannot afford anymore to miss out on any gains in the market because everyone is bullish on the market. If you're a money manager right now, you can't call your clients up and say, hey, I think we should be cautious in the market because I see sector deterioration and everyone's getting crazy. We need to get out or sell some of our positions. You can't do that right now because if the market goes up, your investors will eat you alive. The mass man, the mass investor, cares nothing about being cautious now because they don't want to miss out when everyone else is bullish. People are manic and take their money away from investment advisors who are cautious right now. And if you doubt the market, people will get crazy and turn on you. Many people, as a result, must buy the market goes up. If you ask Henry Ford a simple question, what did people want in 1900? He would have told you what they want is faster horses. People don't care ultimately what's good for them. They only care about what they want. All that said, a rally is likely, though. I'm telling you, the big picture is scary, but the short-term picture, which is all anyone cares about, in that picture, a rally is likely. Why is a rally likely? Support's held for the Nasdaq over the past 8 weeks. Yes, we had a big dip in March and in April, but the Nasdaq held the 200-day moving average. It held the 4,000 level basically 4 times, and now it's in a position where it can break through recent resistance and rally back up to 4,300, up to the March high. Who knows? Maybe it can go up a little bit higher than that. Since the Nasdaq is the weaker of the 3 major market averages in the United States, that's the important thing to know. And the worst sectors in the market are actually in a position to bounce too. This is electronic stores. This is the worst performing sector in the 239 TC2000 sectors so far, year to date. What has it done? Well, it's based and it's in a position where it can bounce and rally. Well, bounce and rally is not going to lead into some giant gains, for 12 months or a year for something like this, but we can get to, we can retrace half the losses or 2/3 the losses or get to the high. That could easily happen. And here's another bad performing sector, gaming activities. Casinos, it's in a position to bounce too. Dairy stocks are in a position to bounce too. These are among the worst performing sectors. And when you look at the 2030 of the worst performing sectors in the market, almost every single one of them is in a position that it looks to me like they could bounce. Here's the Russell 2000, which has been a terrible performer in the market too. Growth stocks, microcap stocks, mid-cap stocks, trading much worse than the S&P 500 or the Dow. It's also in a position where it could, break a trend line here and have a rally back up to its March highs. Bottom line is, the worst performing sectors in the market look like they're likely to rally, in June and maybe in July and August. What's that mean? Summer rally likely. But it's a rally because of the bigger troubling long-term picture. It's a rally that will have an effect of trapping the people that are bearish on the market now, who are trying to short the market or are out of it and can't afford to be out of it. It's going to trap them. But the honeypot is going to trap the bulls too when the rally ends, because they're going to get sucked in also, because they aren't going to have the ability to take profits or be skeptical about what they see. They're going to be converted even more into being true believers that the market's going to go up forever, which is nonsensical. What this means is, if the market does rally, there will be a time when it'll be necessary to reduce exposure to take profits. In fact, if we reach a 60% bullishness level in the Investors Intelligence Survey, we can in fact reach a point of true danger in the fall. At a minimum, when the rally ends, a big correction will erupt. 10% corrections happen. The market is very volatile. In the past 100 years, 95 years, we've had 53 declines in the market of 10% or more. That's once every 2 years. They're just typical. They happen. They're natural. And worse things happen too. You get vicious bear markets like 2008 and 2000 that kill the individual investors in it that don't adjust. And that could happen too. But we haven't had a 10% correction since 2011. We've had 3 years of that one. In 2013, we went straight up. Corrections are necessary because they shake people out. The lack of correction, serious correction, for the past 3 years has caused more and more people to hold, more to pyramid up of margin. So once a correction happens, it's going to be even worse because we've just sucking more and more people in. So I think a rally here can lead to, at the very minimum, a violent correction sometime once it's over. All we've had this year is a pause, and many are nervous and can't afford to miss out on more gains. And tens of thousands of people, in fact, want to play more now in the market, and they want to lever up with more margin. A rally here will cause many more to buy. They'll cause people to flock in to various stocks, whatever's moving, whatever's going up. And that's what I think is going to be the story of the summer. What do? Well, you can play a rally too. We'll get to that in a second. But you need to understand the big picture context. A rally within a stage 3 top is a dangerous situation once the rally ends. Now, if you want or need to play the game, accept that. Understand you're not investing at this stage of the game, and you're late in the game, and that's why it's not an investment situation. You got to understand that so you won't get sucked in to the mass mind psychology that the market's going to go up forever. You don't have to worry about risks, and you can just become a gullible. The gullibles will be killed when the next bear market comes, and I don't want you to become one. So, if you want to play the market, play the market. You can buy, you can take a trade, as long as you're willing to take profits on it at some point once it plays out. Understand that. You can do fine. But I just want you to know what I'm thinking, what I'm seeing in the market, why I think a rally is in fact very likely now over the next 2 or 3 months, but why you can't make that rally, if it happens, make you think that you're invincible. And we'll monitor the situation as each week goes by, as the months go by, and we'll play these markets together, and we'll continue to communicate with each other. So thanks for taking the time to watch this video, and I'm here for you, and have a good Memorial Day.